Good afternoon, everybody. It's Close of Business Tuesday here at TPH, and we're really excited about today's conversation. We're going to focus on the energy transition, and we've got a fantastic guest who's going to help us walk through his firm's thinking on that important topic. We've got Mackenzie Davis. He is a managing partner at Sailing Stone Capital. Sailing Stone is a global resource investor. Over the years, they've written various white papers and thought pieces about what they think is going to happen in the energy world. And today, Mackenzie's going to share with us their views of the energy transition. So welcome, Mackenzie.
Thanks very much, Maynard. I appreciate the opportunity to speak with you guys today.
It's fantastic to have you. We're going to kind of do the Letterman show, Mackenzie, and hold you as our anchor guest while we rip through a handful of upfront items. It was a busy day in the market. Unfortunately, we had some very sad news out of Beirut. Earnings is happening. We had some big news from BP. So let me start, Mike. Oil and gas, what's going on in those markets? Both commodities were up today.
Yeah, I think what we're seeing with oil, oil specifically is people are expecting a pretty good inventory draw number after the close today. With APIs, it came in at around 8.5 million barrel draw versus consensus around 3.5 million. And you're probably going to see something replicated tomorrow in the DOE. I think the second thing is the Beirut bombing. I think that was totally unexpected. You saw crude oil rise pretty significantly when that happened because of concern over regional conflicts, because we just don't know what happened at this point yet.
And nat gas, it had a nice pop today too.
Yeah, that nice pop significantly yesterday. I think that's a combination of just better weather in Europe, hotter weather in Europe, hotter weather in the U.S. I think nat gas broke through some really technical buying points, and so it's just kind of fed on itself here over the last 2 days.
Matt Portillo, we're about halfway through earnings season. Tell us what some of the big takeaways are at the turn.
Yeah, Maynard, I think it's been a pretty constructive setup so far from an earnings standpoint. Companies have delivered on a number of different goals they've been working towards over the last year or so. First and foremost, really focusing on costs has been a big theme that we've seen, whether you're talking about gas producers, oil producers, service companies. It's really about driving down costs and trying to expand margin through cost management. Secondly, on the upstream side, we continue to see pretty significant drilling and completion efficiency gains, which is driving down D&C capital, and again, allowing producers to generate more free cash flow. And then I think companies are realizing that as we come through the cycle here, it's going to likely look like a different world from growth. And I think from the upstream to the downstream, producers are really starting to manage their businesses towards a lower growth business model. This generally means lower overhead. It generally means lower growth. But it could actually generate more free cash flow and create a healthier industry over time. And it is something that's becoming extremely topical, especially with the integrated space, as the integrated companies start to think about the next 10 years from a allocation perspective.
Awesome. Matt Murphy is joining us today. Matt's a director in the integrated and upstream coverage area of our research group. Welcome, Matt. There was some news today out of BP early this morning when they reported earnings. Why don't you give us some of what that news was? It seems like a particularly good topic for today's discussion around the energy transition.
Yeah, thanks, Maynard. So yeah, BP announcing this morning a new strategy in getting into the energy transition over the long term, a new capital allocation framework. Certainly received quite well today in a sea of a fairly challenging environment for much of the company's peers. And the company, in shifting into the deeper into the transition, laying out the capital they're expecting to spend of that over time, looking at as much as 20% through 2025 of their $15 billion or so capital program, shifting north of 30%, around 33% by 2030 as they dig into renewable power, hydrogen, biofuels, and carbon capture and storage, for example. And at the same time, shifting lower in their upstream production through managing the portfolio, as well as fairly sticky investment, dropping as much as 1 million BOEs a day through 2030, further rationalizing in the refining footprint as well, using as much as 500,000 barrels a day. So certainly shifting further into that transition, low carbon environment.
So one question for you, Matt. I know that making these types of shifts, the investing community today it tends to like it when you're reallocating your portfolio in these directions. But on the other hand, as you tick through all those flavors, do any investors say there's more technology risk in the company's business plan now? There's more, what's the risk of the capital budgets coming in line or as projected? How do people perceive that? Because it's obviously very ambitious and lots of variables in how all that works out.
So I certainly think that there are aspects of this transition and the investment that are certainly attractive to investors. So number one is certainly the stability of cash flows. We know well the cycles that we tend to go through in the commodity business. So I certainly think that that's an aspect of it. And from the technology side, certain areas like hydrogen, certainly some room to go in getting lower on the cost curve. But as far as where they're primarily focusing their transition investment offshore, onshore wind and solar, I certainly think that they're quite comfortable in shifting further into that. And what they did highlight is that the returns can be quite competitive with the sort of traditional integrated business model as the unique value chain approach that they're looking to take, looking to get the returns north of 10% versus sort of the 8 to 10% historical PPA levered up return model.
Okay. Well, Matt Portillo, you've been doing some work around electric cars. I think that's probably the world that is, everybody has, some tangible connection to what's happening with transportation. Why don't you give us a couple of thoughts on electric cars, because I know you've been thinking about it.
Yeah, sure, Maynard. Love to share just a couple quick slides the research team pulled together here. This is just some initial thoughts into how the auto market might evolve and some of the macro implications that could come from this. And so if you look at the first slide we're presenting here, this is really just about optionality. If you look back to 2018, there were only about 100 electric models available globally for consumers to choose from. And in 2020, that is expanding to about 160 options. But the big sea change here is really going to come over the next 5 years. And as you can see, by 2025, there's going to be a 400 to 500% increase. So somewhere between 400 and 500 different vehicles globally be electrified in some different format. And that's important because it gives consumers choice. And I think what you saw was a lot of the auto manufacturers, particularly out of Europe, have jumped on this over the last 2 years and have really started to invest to shift their auto fleet dynamic. And then more recently, we've seen the U.S. auto producers like GM and Ford also move into the sector. And so on the right-hand side of this page, we're just basically laying out the capital investment from some of the larger auto manufacturers globally. And what you can see is just between the 5 names we're talking about here, you're looking at about $60 to $70 billion of capital that is likely to be spent over the next 5 years electrifying the auto fleet. As that expands, it's really going to offer, an opportunity for market share shifts, and will be something important to watch. On the bottom left-hand side of the chart, this is really just something that's kind of an interesting dynamic. If you look back to the auto fleet 2018 and what was available to consumers, generally it wasn't mass-produced vehicles that were of an attractive feature. And now we're starting to see a pretty significant expansion of the autos being offered by these manufacturers that are in line with their most popular brands. And that is going to be an important discussion in terms of the acceptance of electric vehicles going forward. On the next page, really just wanted to walk through some of our thoughts around how the market's valuing EVs. And we don't have a view on relative value in the sector, but I think the right-hand side of this chart is pretty interesting. On the right-hand side of this chart, looking at the number of vehicles sold by Tesla in 2019, it was about 367,000 cars. And then the bar next to it is essentially the top 5 auto manufacturers globally, how many cars they sold, and which is almost 40 million units. Yet the market, from a value standpoint, if you look at the relative market cap, the 5 global auto manufacturers that we're highlighting have about a $340 billion market cap, relative to Tesla, which as of yesterday was about $270 billion. So the market's obviously describing a lot of growth going forward to that EV dynamic. why that's interesting on the left-hand side is really the strategy that we're talking about from an auto manufacturer perspective and how they're going to attack the market. And these are some of the largest auto manufacturers in the world and their plans over the next 5 years. And the punchline is that if you just look at the planned expansion and the sales targets by 2025, there's a very good chance globally that these auto manufacturers are essentially going to sell somewhere between 10 and 15 million units per year that are electrified in some way, shape, or form. Volkswagen in particular is making a huge push into the EV market and all the things that are associated with that. The last slide is just a slide that really covers why EVs are starting to really make their way into the mainstream. A lot of it has to do with global policy, but some of this actually has to do with costs. And so on the left-hand side of this chart, effectively what you're looking at is battery costs since 2010, and they've come down by 85%. And you are going to see a significant scale of infrastructure expansion associated with batteries coming on over the next 2 years. A lot of auto manufacturers are vertically integrating. They've partnered with major producers like LG Chem, Panasonic to expand their capacity. That actually offers the industry an opportunity to potentially get down to below $100 per kilowatt hour, which actually starts to potentially push the barriers to where electric vehicles on an unsubsidized basis can compete from a heads-up perspective with traditional internal combustion engines. And once that becomes the market dynamic, that potentially causes a significant shift in adoption of electric vehicles going forward. A couple of quick things to watch on the industry front over the next few months. Tesla does have a battery day on September 22nd, which will be pretty important. GM is going to be holding a tech day in China. And then some of the longer term trends that industry participants are looking at, especially around solid state batteries. This is essentially the next technology that could find its way into the market. We're likely looking at something beyond 2025. But why solid-state batteries are becoming important is if they are successful, they potentially offer significantly greater range, potentially 500 miles on an individual charge, faster charging time of 15 to 30 minutes. And we have seen a big improvement in traditional lithium-ion batteries. Most of the new vehicles being launched potentially have a range of 250 to 400 miles. That was another big limitation to initial adoption of EVs and something that's progressed pretty significantly. And then lastly, just to close out here, just wanted to show that these aren't your traditional kind of EVs you might have under the Prius or the i3. These are some of the new vehicles hitting the market over the next 1 to 2 years. And I think they're quite attractive for the consumer. And so this is going to become a really interesting market dynamic to watch because it has both micro and macro implications for the industry over time.
Think about what your ideal vehicle is, and we'll circle back and maybe ask you before the show's over to tell us what you really want to be driving. It'll reveal a lot about your personality. Okay, Colin Fenton, give us Colin's World. Give us 2 minutes if you can, and then we'll move to McKinsey.
Sure. Well, as we discussed, global markets are getting increasingly concerned about geopolitics. Not just the bombing that happened today in Beirut, but the deterioration in relations between China and the United States, where we had the closure of the 2 consulates, and then, of course, also the TikTok situation. And so today what I wanted to do is to show something good. So let me share the screen here. So this first slide shows China's crude oil imports from all origins. You can see the June 2020 number was a blockbuster, 12.99 million barrels per day, literally off the trend line. And to put that in context, it's 2.186 million barrels per day above trend. Now, obviously, it's price driven. That April 2020 Brent price at $26.63 was a pretty strong motivation to go buy the barrels. And importantly, China's imports of U.S. crude from the United States participated in that flow. You can see that in the November 18 to March 2019 period, when the so-called trade war was in full force, there really wasn't much two-way trade in energy. Get into early 2020, phase 1 of the U.S. trade deal gets written, and we did actually see the Chinese pick up some U.S. cargoes. Now, obviously, it's a question mark on whether phase 1 of the U.S.-China trade deal is still intact, but late today, August 4th, we got some good news. The U.S. and Chinese officials plan to meet on August 15th to assess the trade deal and compliance. And so we read that as a positive on the margin. When we look at the United States at demand, we find that air traveler traffic through USA TSA checkpoints has now gotten back to the March 17 level. 2 days ago, we almost saw 800,000 people go through those checkpoints, which is definitely breaking above that trend. And so while U.S. oil product demand growth is still soft looking year over year, particularly in that jet fuel segment, we are seeing refineries respond by increasing utilization. We'll get some more data tomorrow from the DOE, but as of July 24th, that 79.5 utilization number was above the low on Hurricane Harvey. So this is the first time we're back to something that looks like normal for the U.S. as a whole, even though individual pads have gotten there before. Coming into August, we also have the tapering of the April 12th OPEC supply deal. You can see that in this chart where we get a bump up in global liquids production in August, then continuing through the end of the year. But even though that gives us a bit of a surplus market here in the August 2020 period and gives us those softer time spreads that Mike was talking about, if our baseline projections for demand for global liquids are correct, we should see the market move back into a deficit later this year. Now, the physical markets are still kind of lagging the financial markets. We continue to focus on gold. Here is the premium for $2,500 calls on the December 20 COMEX contract. I mean, look at that explosion. It's a 600% return in 11 trading days, or about 2 weeks of real time. And you can see what's driving it. The underlying futures have propelled past $2,000 per troy ounce for the first time in this market's history. And on the bottom, you can see when the expiry dates are for those futures contracts. But we still have a problem in the oil market in that the options are nervous about the possibility of dipping below $40. You can see here the options allocate essentially a coin toss to that probability in the November 2020 to June 21 time zone. And so we are looking at indicative pricing for producers to put on collars where if they sell the 45 calls across these tenors, use the proceeds to buy $40 puts, it's about $1 net paid. And so that looks interesting to us and something that we would advise producers also to look at.
You know, I'll share something with you, with all of you. We asked a question in last week's survey about getting back to $50 WTI by the end of this year. And 66% of our viewers either disagreed or strongly disagreed that that was going to happen. 20% were neutral. What do you make of that, Colin?
Yeah, I mean, it sounds right on target. When we talk to producers and we try to project out what the most likely paths are for demand, what was our original baseline projection maybe 2 or 3 months ago, we saw some pushback from clients. They were a little bit more pessimistic than we are, and I have to admit, we've been moving more towards their view than the other way around. And so I don't know if the real number is 50% or 2/3 probability, but it's certainly true that we have some headwinds here in the September and October period, and we may be in the eye of the storm, at least ahead of those next couple of months. Then we get to McKenzie's thesis on, what does it look like after that kerfuffle perhaps ahead of the election.
But we started seeing some better coronavirus data today in a few places, Florida, Texas, Arizona, California. Very small, nothing huge, but I mean, how you answer this question obviously seems to have a lot to do with how you see things playing out. The other question we asked is about the presidential and congressional elections having significant implications for the oil and gas industry. A whopping 90% of people agreed or somewhat agreed, strongly agreed or somewhat agreed, but that one is, there's a lot on the horizon. Thanks, Colin. Well, let's jump in, and joining us to talk with McKinsey is Craig Webster, TPH's ESG guru. McKinsey, welcome. I'm sorry it took a while to get to you. I had to work through all these brains, to get to the big brain. But welcome.
Thanks, Maynard.
I think what McKinsey and I talked about it ahead of time. We thought it would be great, and thanks for obliging us, McKinsey. If you walked through your presentation on the energy transition, your firm's views, and maybe as we pull that up, you could just give everybody the context for what why you guys did this, what you use it for, what's really the bigger purpose, if you will.
Yeah, certainly. Let me see if I can. So I think this is probably a reasonable cartoon to start the discussion. But the impetus, I guess, behind the paper was as we were talking to institutions and talking to investors, increasingly it was becoming pretty binary. Yes, we're interested in the energy transition. Yes, we're interested in and concerned about ESG issues, climate change, and no, we're not interested at all in talking about investing in upstream commodities. It's an emotional topic. It's sometimes hard to sort of get past the headlines. And so what we thought we would do is to try to put the emotion aside and just look at some of the data. And I think, Matt ran through some of the data on EVs. There's some data as it relates to what the outlook is for renewables penetration, and then to think what the implication is for upstream commodities. And so that was really the idea. I think one of your earlier speakers talked about appealing to the radical middle. I'm confident that the radical middle is the majority of the people that are listening to this and are interested and engaged in these discussions. And so that's, I guess, maybe the target audience.
Do you think, McKinsey, because you talk to endowments and various funds, institutional investors all over the planet, is part of the problem that people haven't really paused and thought it through? They haven't really seen the data or seen the analytics, or do you think honestly they have done the work and this is what they think? What is how did we get here? Because it's a long way back to the middle is the way it feels sometimes.
Yeah, no, I think that's fair. I think for a lot of investors, they have constituents with really, really strong opinions. And whether those opinions are well informed or not really isn't the point of the conversation. They exist, and you can see the market reaction to BP's announcement, as Matt was discussing earlier. So there's a huge amount of momentum, and I think concern, and that legitimate concern in people's eyes. There was a great survey that was done. It was about 30,000 people from 28 different countries. And more than half of the respondents thought it was likely or very likely that climate change would lead to the extinction of humanity. So think about that's a pretty broad swath with some fairly draconian conclusions. Yeah. So I think that there's a constituency that has legitimate concerns, and the concerns are valid. I also think we're in an environment where it is very difficult, as I said earlier, sometimes just to move past the headlines. And so sometimes it's easier to write a paper and be able to read it and refer to it than it is to sit down necessarily and try to have discussions. It sort of frames the debate a little bit. So what I wanted to do is just to provide a little bit of context around what the composition of world energy is, what the energy transition means, and then think through what the implications are for a couple of upstream commodities that we think are going to be pretty integral to allowing what I think today most people want to happen, which is to figure out a way to have cleaner, more abundant energy. And so for backdrop, the world consumes about 600 exajoules of energy every year. What's an exajoule? Rough math, if you ride the Tour de France, you consume about 25 megajoules. If everybody in the world rode the Tour de France 5 times, that's 1 exajoule. And so if everybody rides the Tour de France about 8 times a day, every day for the year, you get to 600 exajoules. So that's what we consume every year. And 85% of that energy comes from hydrocarbons. You can see on the right-hand side, natural gas has been taking share for the better part of the last couple of decades. Oil's been in decline. Renewables have inflected over the last 15 years. They make up about 5% of primary energy today. And coal, interestingly enough, actually was rising pretty significantly through China's big expansion. It's only recently that coal has rolled over. And so as you then think about that in the context of greenhouse gas emissions, you can see energy is the preponderance of anthropogenic greenhouse gas. And it's really in the lower right-hand side, electricity, heat, and transportation that has driven most of the growth. and that is they are the largest contributors to the greenhouse gas. And so as we think about the energy transition, it's really focused on electricity, heating, and transportation. So this is final energy, not primary energy. So this is at the bottom. This is non-energy coal, non-energy oil, or non-electricity oil, non-electricity gas. And then you can see that the growth in energy supply is coming primarily from electricity. And the forecast as we move forward is that this blue wedge will grow. There's an assumption around efficiency gains, which I think is probably a jump ball, but it's likely to be required if we're going to come anywhere close to achieving what we're talking about achieving. But the idea in the energy transition is basically to green the grid. So you blow up this blue wedge, this upper right-hand side here, and you're moving from mid-single digit components of electricity coming from renewables to closer to 65% by 2050, and then to move a lot of these end markets, transportation, obviously with EVs, buildings, manufacturing, displacing fossil fuels and moving them on the grid. So the energy transition at its sort of most fundamental state is to green the grid, make it as renewable as possible, and then get everything on the grid, or as much as as we can.
And Mackenzie, with those charts on the right, is someone also doing the implied greenhouse gas emission growth that comes with all that, and
Yes.
coming to the conclusion it's much better?
Yes, that's right. And particularly at the end of this little summary, we can go through and sort of look at what the composition looks like and what the emission profile looks like. These systems obviously are incredibly complex, and so these are sort of finger waves in a direction more than precise estimates of what's going to unfold over the next 20 or 30 years.
And both Colin and Michael Schellenberger would want us to ask you what you thought of nuclear and what happens, what's the guesstimation there?
Yeah, nuclear has a role to play for sure, and you can see that in the developments in some of the emerging markets, China in particular. It's a fairly long build cycle, and so as you look at the explosion in forecast electricity demand, we'll talk a little bit about it. There is some questions around just the ability to meet that demand with nuclear alone. But it certainly is part of the recipe. It's just the response time and the build time, I think, is going to make it difficult for it to meet what the energy transition is going to require over the sort of short and intermediate term. It's sort of ironic to sit back and we're in the middle of this global pandemic, but in some respects, I think in many respects, the coronavirus has actually accelerated the commitment to the energy transition. We've seen people talking about being able to finally see the Himalayas. Again, this is just satellite pictures over India, and it gives you a pretty good idea of how quickly nature can heal if it's given the chance. Obviously, in the post-pandemic world, finding ways to reinvigorate economies, protect jobs, become increasingly important. The EU's Green Deal is a €7 trillion plan. Goldman estimates every euro invested creates about 0.8 euros of global GDP growth. So there's some economic considerations as well, and it's clear that the commitment behind the energy transition, at least as we sit today, is large and growing. And so if you include states like California and New York in this calculus, it's a little more than 53% of global GDP who have either made the commitment to get to net zero emissions by 2050 or have stated that they're going to make the commitment at some point in the not too distant future. So there's a lot of impetus behind the energy transition. The other piece of it is a humanitarian consideration. I know in earlier, some of your previous calls, you've talked about energy poverty and energy access. And on the upper left-hand side, you see the distribution of energy consumption per capita across different countries and regions of the world. It's pretty striking. And then you look at where that population growth going forward is likely to occur. It's a little bit hard to read, but it's Asia and Africa with obviously the bulk of the population growth, very low access to energy today, And if you look at the generation mix in those regions, they're still reliant on fairly high polluting fuels, including thermal, which is just a nice way of talking about burning wood and grass to try to heat your home and cook. And so the humanitarian implications are pretty clear. The WHO estimates about 4 million people per year die from indoor air pollution. About 11,000 people a day, 450 people an hour, every hour. So the energy transition is partly an environmental, addressing some environmental concerns. There's an economic component to it. And then there's this humanitarian aspect as well of just trying to expand and rapidly expand access to cleaner fuels and what people are relying on today.
Mackenzie, I'm not sure if you have a view on this or not. One thing that has come up pretty frequently in conversations through the last few months of doing these videos is just a discussion around energy security. And in the U.S., capital investment at the drill bit does to some degree supply energy security to the United States. However, China and India in particular are quite short energy supply in general. And so I'm just curious how that may or may not impact their views on investment in various different energy commodities going forward.
Yeah, I think China is maybe the most obvious example because they've been very consistent in their approach to securing access to the raw materials that they need. And this is not a development over the last 20 years. It's been an approach that they've taken on and off over the life of the country. But if you look at on the mining side, we spend a decent amount of time in mining and look at where the investments are being made in commodity-rich countries in Africa. The Chinese dominate. We'll go through a list of recent copper transactions. The Chinese are everywhere. We looked at the Chinese imports in oil, and they're highly counter-cyclical. We can see the same thing in the copper market. And so, as I think from an energy perspective, the ability to gain access, particularly to natural gas, and to gain control over natural gas, I think has to be part of the calculus. And as we go through cost curves and resource availability, which we'll do in a couple of slides, I think it becomes evident why we believe North America is so advantaged on what we also believe is going to be a key bridge fuel to allow this energy transition to occur. So I think it's part of every country's calculus. It has to be, and North America happens to be particularly well endowed in natural gas. The U.S. is sort of an interesting case study. I won't spend too much time on this, but if you look at U.S. emissions, they've fallen about 25% over the last decade or so. So it's clear that we can have a fairly robust economy, meet the energy demands of that economy, and continue to cut emissions. And that's largely been driven, obviously, by natural gas and more recently renewables driving coal out of the power stack. And this on the lower right-hand side is a forecast of what that looks like. Explosive growth in renewables, but natural gas doesn't appear to be going anywhere. And so this is the summary slide, Maynard, to your earlier question. Here's where we are in 2018. This is the low carbon mix in the middle, which is that dark blue bar, getting closer to zero emissions by 2050. The base case is just a reduction in the rate of growth of emissions. Again, renewables are absolutely critical, but natural gas plays a pretty key piece of this. And obviously coal, that green bar, effectively disappears from the mix over the next 20 or 30 years. So the energy transition is occurring, in our opinion, and it will be built on the back of renewables, but also natural gas plays a pretty important role.
So one thing, Mackenzie, we've noticed this comes up, and just curious what you think. You'll hear some people say solar is absolutely as cheap as natural gas right now. Same for wind, if not cheaper. You'll hear other people say absolutely it's the other way around. Natural gas is cheaper. You can imagine who says what. But there seem to be some, there's some embedded assumptions when both sides are saying what they're saying. Do you have a view on that?
I mean, I think the technology is having the biggest impact on solar costs. They look very similar to the lithium-ion chart that Matt showed earlier. Wind has started from a lower base, but there's been sort of less progress there. We're starting to approach the metric that people use as LCOE, or the levelized cost of energy. You're at a very high level. You're starting to approach parity. The problem with those LCOE calculations is that there's so many assumptions, as you mentioned, embedded in them. So it becomes frequently a very local question: access to grid tie-ins, land availability, et cetera.
And it seems like an obvious one is, what is your forecast for natural gas prices? And it seems like the renewable community implicitly forecasts the potential for higher prices than the natural gas producing community. But that's just my impression.
No, I think that's right. When you start to read the fine print in those LCOE calculations, you'll see different price decks, different commodity price escalation assumptions that are in there. The reality is that we have a large installed base of relatively clean gas-fired power plants that in the U.S. are running at about a 30% capacity factor. Globally, they're running about a 40% capacity factor. And so maybe on new build economics, you're starting to approach parity on a very site-specific basis. But for existing fleet capacity, I think there's a long way to go. And again, that's part of the incentive to do this work, is to highlight the fact that, for instance, we saw the cleanup over India and the reduction in airborne particles from COVID-19. Unfortunately, that's a one-time shock that has some pretty negative consequences for other aspects of people's life around the world. The estimate is that it's about a 7.5% reduction. We'll see a 7.5% reduction in global CO2 emissions this year. If you just increase the global capacity factor for gas-fired plants from 40% to 50%, you'd have a permanent 4.5% reduction in greenhouse gas emissions. So you can get more than 60% there without a pandemic. So there's a huge installed base that's available to be leveraged. Maybe natural gas isn't part of the final solution, but again, based on the technology that we see today and the alternatives, it's hard to imagine that gas isn't a pretty important part.
Okay.
Hey, Kinsey, given your kind of outlook for natural gas demand growth, when you look at the supply side of the equation, how did those two things marry up? Because the world has been awash in cheap, affordable natural gas and cheap, affordable crude for quite some time, and we're seeing a shift in producer behavior in areas like the U.S. where we're reaching maturation of some of these basins, inventories becoming a bigger discussion. So just curious if that's something you guys have looked at and thought through over time.
Yeah, we have. These are actually some pretty interesting slides. This isn't our work. But I think what's interesting about particularly natural gas is if you look at this forecast for demand, increasingly the growth on the supply side is coming from unconventional onshore. And if you look at where that unconventional onshore resource is, it's largely in North America. If you then sort of zoom forward and look at the global cost curve, North American natural gas actually sits at the bottom of that global cost curve. So it looks very different than the North American oil resource, which sits in the middle of the cost curve. And then if you look further within the North American cost curve, what you end up discovering is that we have a large amount of inventory, particularly in the Marcellus, southwestern Marcellus core, and in the Montney. So call it 10 to 15 years of relatively low-cost inventory that's available to be developed. So there is supply out there that works. I think the question that you're asking partially, Matt, is does it work in a $2 environment? Does it work in a $2.50 environment? We think it actually clears closer to $2.75 to $3, and we've done some analysis on that, if I can ever figure out how to grab this thing. So what's interesting, the heading of the slide, I think, says it all. Don't confuse capital availability with economics. If you look at the supply additions in 2018 in a $3 environment, you had about 2 BCF a day, largely in the Utica and the Haynesville, but some higher cost Marcellus as well, that came into the market that simply didn't generate a return at $3 gas. You roll that activity forward into 2019, and it's closer to 6 BCF a day at a 260 average commodity price. And so I think what you're seeing from a supply standpoint, both in gas and in oil, is that when you remove the false sort of catalyst of external capital and you force these businesses to operate within their own cash flows, you get a fairly quick return to what the underlying economics are. And if you look at the bottom right-hand slide, I apologize if these are a little bit small, what you see very clearly is that the North American rig count reacts pretty quickly to changes in commodity price. When gas prices go below 275 an MCF, the rig count rolls over. When gas prices tick up above 275 an MCF, the gas prices or the rig count starts to pick up. And so we think of gas as being a $2.75 to $3-ish commodity based on the work that we've done, and we can see it sort of tie out and correlate with the drilling activity. The question is, as we start to drill those core locations out, yes, we have 10 to 15 years of low-cost inventory, but it's $3 to $4 inventory, not $2 to $2.50 inventory. That's the conclusion that we've reached based on our work.
So Mackenzie, is that another way of saying all these changes you're describing in the North American gas, when it starts to feel a significant shift up in price, that it sounds like you're saying that's after we run through our best inventory. Like, I think that's what we all wonder is, we all know North American natural gas is the wonder fuel. When does the world consume so much of it that prices move into that $4 area?
Yeah, I think absent weather anomalies and things like that, we've got a run with the work that we've done. It appears that we've got a runway of 3 to 5 years, and that around $3 an MCF, maybe a little bit higher. And as you progress farther along, and we'll see what technology does from a deflation perspective, that's when you start to move closer to sort of 350 to 4. But as a participant in the gas market or an investor in the gas market, I can tell you that I don't even know what 4 feels like anymore, but 3 would be terrific.
Yeah.
When you think about sort of that $2.75, $3 level, where does the cost structure of renewables, of wind and solar plus storage, have to go then from here before that's not competitive? We talked about the sort of the renewables advocates will use a higher gas price, but how much breathing room is there as the renewables come down? And no doubt that cost drops will flatten over time, but is there a breathing room there?
Yeah, you're going to need to continue to see continued improvements, I think, in renewable economics. Storage is a jump ball as far as I'm concerned. The storage that is being implemented today is largely a reaction to government mandates. The work that we've done shows that putting Tesla power walls up and charging your ratepayers for the benefit of getting a little bit of power from a battery installation is not an economic decision, it's a policy decision. There are some early stage and fairly interesting technology developments at close around more grid scale, utility scale storage, but they're in their nascent stages and they're just starting to pilot. So I think we'll get a better idea over the next couple of years. But I think you'd need to see somewhere between 15 and 25% improvement in solar and wind economics before they started to compete heads up with natural gas at gas around $3.
And you sort of alluded to policy there, but politics is part of this. And as we go into the election, coal is we know where coal stands, but gas has been such a big part of lowering the emissions in the U.S. Do you think that there could be, they could find fans in no matter who's in the White House for natural gas, or do you think that one outcome is okay and one outcome comes with real headwinds for gas itself?
Yeah, again, I think it's hard to get the the physical dynamics that exist today require a certain range of outcomes, and they don't necessarily tie to what's expedient to talk about on the sort of on the campaigning stump. And so I think people can posture all they like. The reality, it's going to be hard to push gas out of the power stack. And I know Biden's talked about net zero emission power in the United States by 2035. We just don't see how that's possible. So I think that what's being talked about as part of the run up to the election and what actually happens might end up being pretty different.
There's another aspect to that I think often gets ignored, and that is if Minnesota coal plant is retired and replaced with a solar-fired power plant, solar plant, but that solar plant depends entirely on a natural gas plant for backup, and this new gas plant is built simultaneously with the solar plant. Is it appropriate to allocate all of the cost only to the gas plant in the levelized calculations? Or do you have to recognize that there is a linkage between the two? And so you can't just look at the cost curve going from 2 to 275, 3 to 4. You have to say some portion of that must be borne somewhere in the system. And that's one of the great flaws of the levelized approach, because it looks at the asset up, but it doesn't allocate the cost down. And in reality, if they're linked, they have to be connected. So, Mackenzie, I think it supports your thesis, but kind of hearing that argument, what's your response?
No, I think that's right, and I think you can see the same dynamic when people talk about what they're doing to achieve, net zero, and are you actually removing absolute GHG emissions from the system, or are you just reallocating it to somebody else?
Yeah.
Dominion's transaction with Berkshire is probably a pretty good example of that. I think they call it virtue signaling. I'm not sure that was the best economic decision for their shareholders. We're not an investor. But it's not clear that decision actually took GHG emissions out of the system. It just reallocated them somewhere else.
Kenzie, you spend a lot of time in the mining industry, and one topic that comes up pretty frequently is the inputs into batteries and some of the metals that are used. So there's a lot of focus on that, especially in a ESG world. Just curious on your views on the cleanness, I guess, of renewable energy, and what are the major concerns as you talk to investors around ESG metrics front?
Yeah, maybe we can switch to mining a little bit, but I think that there's if there's an aversion today to investing in energy, there's a bigger aversion to mining. It's a bigger industrial footprint. It's a much more on-site processing than you typically see in the energy business. The flip side of that, though, and again, this is part of the genesis behind the paper, is when you start to peel back the onion a little bit, and you look, for example, in this lower right-hand side for copper, basically every energy transition application requires copper to some degree or another. In the EV space, it is the dominant metal, that orange bar. In order to meet government targets for EV penetration, it's going to require a lot of copper. Interestingly, the mining industry has gone through, whether this is Shale 2.0 or Shale 3.0, whatever the energy market is doing today, it started in the mining industry 5 or 6 years ago, where shareholders basically removed boards and executive teams of all the major miners. Those companies and the new management teams and boards committed to returning effectively all discretionary capital back to owners through dividends and share repurchase, and to clean up their operations. And so you've seen two things happen. One, the supply side has been starved of capital for 6 or 7 years now. And two, there's been a tremendous improvement in the ESG profile of mining, because I think the companies correctly identify the fact that they're not going to be able to continue to operate if they can't clean up their operations and be much more transparent than they had been in the past. And I think energy's probably 5 years behind them on that. But the challenge for renewables, in our opinion, isn't whether or not there's going to be enough appropriately produced commodities. It's going to be whether or not there is going to be a sufficient supply, sort of full stop. And so you look at this is a slide that just shows a 10 to 15% increase in copper demand just from EVs. You roll through and look at the copper intensity of renewables, and it's up to an order of magnitude different between conventional power sources like coal and nuclear, all the way through to offshore wind. And so if you take the EIA's base case in 2050, you're talking about 150+% increase in mine supply in 30 years. It took 200 years to build the current production base. It's 3.2 compounded annual growth rate. The IEA accelerated case, which my guess is probably becoming more of a base case scenario, it's a shorter time frame, but it's about a 35% increase over 3 or 4 years. That's an 8% CAGR. Now, in the gas market, if somebody told you that gas demand was going to grow 3 to 6 to 7%, it's North American gas, you say, no problem, we can meet that demand. Mining is not short cycle. There's just no way around it. Anybody who's stood on the edge of an open pit understands that it takes a decade to build a new mine, and it's several $1 billion of investment. And so what you see is that even in a period of very, very high commodity prices, $3 to $4 copper, the industry managed to post a whopping 2.8% growth in production. This is all in people tripping over themselves trying to build mines everywhere in the world, blowing through capital budgets, destroying value for shareholders, and the best they could do over that 12 or 13-year period is a little bit less than 3% supply growth. Prices rolled over, so is supply. And so now you're in an environment where there really hasn't been any technological innovation since the early 90s, and the ability to economically mine low-grade porphyries. There haven't been any great exploration successes. I can count them on fewer fingers than I have on one hand of truly tier one assets that have been discovered in the last 20 years. And so you have a market where I think the demand for copper over a 10, 20-year time frame actually looks pretty good. The challenge is going to be on the supply side.
I just wanted to ask you one question. We had a survey question last week, and the statement was, I think ESG related, the push that ESG is having into oil and gas will make us much better 5 years out. About 25% of the people thought they were neutral on that comment, but 40% agreed, and almost 20% strongly agreed. So, not quite 60% of our viewers were thinking that ESG is going to make oil and gas a lot better. I was thinking of your copper example when you said that. With the one question about supply, because it looks like, copper is going to face, it didn't reinvest, it was paying out all that money. Are we going to be short copper, and is the same thing going to happen in oil?
Yeah, I mean, the market will clear. It always clears. I think to the extent that you see a period of much higher copper prices, you'll see scrap supply come in. You'll see smaller mines come into production. The challenge in copper, I think, is that there haven't been any great substitutes or alternatives for the type of applications that we're talking about. And that's why we're such big fans of EVs. We believe in them. We believe in the economics. But as I said earlier, I think thrifting, improving efficiencies, shifting demand away from what are, by definition at a certain cost, finite resources is going to become increasingly important for the world. I don't think the world economy operates very well at 100 million barrels a day of oil demand if oil is 100. And if one of the largest producers just told you they're dropping 1 million barrels a day of supply, and we know shale oil doesn't work very well at sort of 45 to 50, I think to your question, Maynard, you're likely to find yourself in a period of elevated commodity prices. In the case of oil, my guess is that it accelerates the transition to the EVs. So the next phase of the oil market, in my opinion, is that we'll go through another spike in price, and that might actually be the nail in the coffin for oil demand, at least from a transportation perspective. Copper is going to be harder.
That probably says a lot about sentiment in the oil and gas world right now. When we think of the next spike, we're worried that could be terrible.
Exactly.
Right. It's been a long, hard road.
Exactly. It's been a while, and it's been longer if you've been in mining.
Well, it's all a fantastic work, and there's obviously so many layers to it. I know you've got a bit of a summary here where maybe we could do your best to summarize a highly complicated, fantastic piece of work.
Sure. Yeah, no, it's pretty simple. I don't think that there's any debate that the energy transition is underway. I don't think it makes a lot of sense to debate whether it's occurring or not. It's clearly occurring, and at least today, there's trillions of dollars of capital behind it. We do think North American natural gas is actually pretty uniquely positioned. I think that global electrification is going to put the copper supply base under a lot of stress. Other mined materials will impact that as well. But the last point, in my opinion, is the most important. And this really gets into, I think, what you're trying to create with this forum, which is a dialogue and an exchange of ideas. But what we hear repeatedly from large allocators of capital is that they've made a policy decision around divestment. And the challenge, I think, is that when you choose not to capitalize a commodity, what that means is that you're almost, by definition, ensuring more price volatility, higher prices, scarcity, and that might not impact you or me. I'm going to fill my car up because I can't have a Tesla yet, but I'm going to fill my car up whether gas is $2.50 a gallon or $4 a gallon. Now, that's probably not true for a farmer in Africa, for a laborer in India. And so you end up with some fairly regressive taxes on the people who can afford it the least. And so I would argue that divestment isn't necessarily the answer. The job is to figure out what are the great assets, who are the great managers, who are managing these assets appropriately, and find ways to partner with them so that we can accomplish what everybody, I think, wants to accomplish, which is let's make the air cleaner and let's improve access to energy on a global basis.
Well, it seems like when you had the page up about here's what the world could look like in 2050, this would be the stack. If we do it this way, we get this reduced carbon, reduced emissions. We should be looking for solutions that take us to that outcome with the least amount of cost. And that means investing professionals like yourself and like the people who put money with you should be looking for good managers, right, who make good returns and also do so in a responsible way. I'm taking a long way to say what you just said, I think, which is don't just write off certain flavors. That's not going to get us where we need to go.
Yeah, and I think it's important to really think about the implications for the flavor du jour. So, hydrogen's a great example where everybody is bullish on hydrogen and largely on green hydrogen. We did a little work in the paper, but if the idea is to get to 20% of global energy supply coming from hydrogen by 2050, what that means is about 6.3 trillion cubic meters of fresh water consumption, because you can't produce hydrogen from salt water. You can only produce hydrogen from fresh water today. That's about 16 times what the U.S. consumes every year. And it's about 35,000 terawatt hours of energy consumption. It's about 1.5 times what the world consumed last year. So we're going to use 16 times U.S. water consumption and 1.5 times global energy supply to produce 20% of the world's energy needs. It's exciting and interesting, and there's tons of room for technological improvement, but we need some guideposts to help think about both policy and capital allocation.
Well, look, as we wrap up, I think the other thing we know, you've been doing it for a long time, McKinsey. You were a founding partner at Sailing Stone. But if you think about the energy world in 10-year increments and think about what the world looked like in 2010 and 2000 and 1990, 1980, you were telling me the other day the reason we built so many coal plants in the 70s is we thought we were running out of natural gas. So the probability that we do it as outlined from here to 2050, we're going to discover some stuff along the way. But let me let you wrap it up.
Yeah, no, absolutely. I think that's right. I think one of your earlier calls, there was a discussion about modeling and the risks of modeling complex systems as opposed to simple systems. And if there's a more complex system out there than energy, I don't know what it is. And the dangers of spreadsheet math, I think, are well known at this point. So that's why these discussions are so valuable, in our opinion. It's why we appreciate the opportunity to come on a call like this, is just to exchange numbers and data and thoughts in a way that engenders discussion, as opposed to somebody closing their ears and screaming at you.
Well, we can't thank you enough for joining. We're going to attach your paper to the blast, or the link to your webpage. And just thanks so much for joining, and thanks for doing all you guys can to make the conversation a better one. We appreciate it.
Yeah,
Thanks,
thank you
everybody.
very much, Leonard. I appreciate it. Thank you.